All right. So per Vaughn's request, I am recording this, and Natasha. So what I was just covering is this setup, and really quick, I'll just recap. So 10 EMA strategy, first bearish candle right here that formed underneath the 10 EMA. My stop went above this candle here. I could have gone up above the high of the day, but looking at my target where I needed to take profit, I wanted that profit taking to take place before this pivot right here. So if I put my stop at the high of the day, my profit target was going to be approximately where this line is right here, which lined up with basically with this pivot. I wanted to step in front of that. So I put my stop above this candle, which technically per the 10 EMA rules, that is where my stop can and should go, because it's the idea is to have your stop above the 10 EMA, which it is, and also above because I'm going bearish, up above a bearish candle that is price action above the 10 EMA. So that qualified right there. So my stop went right here at 113.58. Entry was right here at 112.42. And again, so this green line down here was my target. Okay. So again, this candle formed, I figure, okay, this trade's going to lose. I knew I had to get below this pivot here for this trade to work. And it came down there, and I was thinking, that's it. It did break below that. This low of this candle is lower than this pivot. I thought, beautiful, this trade's going to work. And then of course it got bought up. I go, okay, trade's not going to work. Probably going to end up now having to play aggressive defense. But then this candle formed, and I love that. Nice little small bullish candle above below the 10 EMA. Again, technically I could have raised my entry up a little bit, but again, the low of that candle was 112.48. Low of this candle 112.45. I'm like, what's the difference? Either way I'm getting in. I'm already in, but I did get triggered in on this one. But that was just another candle that I liked, because it was, look how small that candle is, right? Tiny little candle, and it formed right underneath the 10 EMA. Oh, there's the market. Market's closed. All right. So then this candle comes in. I'm like, boom, great trade. It's going to work, right? Felt pretty good about it. But again, look where it stopped. And this is, this whole conversation today is about different indicators, right? Well, look exactly where it stopped, right on the VWAP. And the VWAP stands for volume weighted average price. We'll talk about that a little bit more as we go on. But traded right to that VWAP. And I go, okay, now I have to get through VWAP, right? So VWAP is, I'll talk a little bit about that more right now, since we are covering that in today's discussion. So volume weighted average price. What do you need to know about it? Well, here's the deal with all these indicators that I'm going to talk to you about today that we're going to go over. Look, my deal is, like, if I ask somebody the time of day, I don't want to be told how to make the clock. I just want to know the time. I'm not that kind of person that digs in deep into how things work in terms of like these indicators, right? I just want to know generally what are they and how do I use them, not like all the technical aspects of it. So if anyone's looking for like a deep dive into the technical aspects of, well, what makes these indicators work and what are they? I honestly don't know, because I don't care to know. I just want to know, first of all, what is it, but how do I use it? More importantly, how is it beneficial to me? Okay. So the volume weighted average price, VWAP, right here, is an indicator that is widely used by institutional traders. Okay. And they are often compensated, and they have incentives for trading in and around VWAP. So one way to think about VWAP is, okay, well, if you're above VWAP, you're bullish. If you're below VWAP, you're bearish. But you also need to recognize that price often, the farther away it gets from VWAP, it's going to want to retrace to VWAP, right? So, and then once you get to the VWAP, then the question is, are you going to get through it, right? But you don't know that. But you just have to be aware that price does like to, it's like a magnet, right? Magnet will draw price to VWAP. And at that point, you just have to anticipate it's going to either continue through it or it could bounce off of it. But perfect example right here is price closed right at VWAP. Okay. Now I'm thinking to myself, unrelated. The point of control and VWAP unrelated. So the point of control is a aspect of the volume profile, which we'll talk a little bit about, but VWAP is a different animal. So VWAP, I mean, if you do want a explanation, like a technical explanation of VWAP, again, going back to my statement that I'm not, don't tell me how the clock is made, just tell me what time it is. It's the average, it's the weighted price of over time. So if I right click on this right here, okay, if I edit the study, so it's giving me, I thought it would say the time. Okay, so on the day, I thought it would give me a number for how many days it's calculating it, but I guess it's just doing it on the day. See, again, I don't really look at the technical aspects of it to even know, well, what makes it work. I just know that VWAP on its just the general default settings are what the institutional traders use, and I just know that I need price, as price gets away from it, it's going to want to come back to VWAP. Right? It gets far away from it, it's going to want to come back to VWAP. And I know that the institutional traders are trading in and around VWAP, and they have incentives to do so. That's really, for me, all I need to know about it, right? And I also just need to know that when price gets down to it, I can expect it to potentially bounce. And so at this point, when it got to here, right? Yeah, TradingView, there are tons. I'm not sure. So Natasha, I'm more of a Thinkorswim user, but I know that there are people, and like Kyle I think Kyle's a TradingView user. I know there are some people in here that use TradingView exclusively. So maybe somebody can help out Natasha and let her know which of the VWAPs on TradingView is the one to look at. But when price closed here, I was like, okay, at this point, I lower my stop, right? Now, again, this is me and my trading plan. So per my trading plan, if I get a candle like that and it's moving in my direction, and I think we can all agree that's a really nice confirmation candle, I can move my stop, even though I got triggered in here, right? To me, for my trading plan, I don't need to wait another, 5 candles, right? Thanks, Tony. Appreciate that. So, Natasha, Tony just posted that in there, the VWAP session high-low close 3, maybe, is that what that stands for? But anyway, so when I saw this candle come in, I immediately lowered my stop, right? I was like, after that, if it bounces out of here, and again, because I'm going counter trend, I'm going to be more aggressive with moving my stop. So I did lower my stop. I don't remember exactly where I brought it down to, but this candle came in. Then when this candle came in and got down into here, I was like, all right, we have clearly broken through this level. This candle breaking through this level right here gave me confirmation this trade can work. Once this candle came in, I think I had my stop like right above this one here. I was like, it should not get back up there, right? It should just run to my target. So it got down here, and it did not eventually, but pretty quickly, it hit my target right on this candle right here. And that's when I hit my 1.2. One thing that I typically like to do is I try not to take, if I think that there's a lot of room for this to run, I will not take off 100% of my trade at 1.2. I'll take off 90% of my trade, and then I'll let the additional 10% continue to run. However, because I knew that this was a key pivot level, I just decided to take everything off here at 1.2R. And clearly it was the right decision because it bounced out of here, right? So price came down, hit my target. I'm out full. I decided not to leave on 10%. I just took it all. Then price gets in here and it comes up, right? So now let me remove these lines. Okay, price comes back up here. And now, so I've gone counter trend, right? Here's I went bearish on what was a bullish trend, right? So now it comes up and then I get this beautiful bearish candle right here above the 10 EMA. So I set up this trade right here. And as I was setting it up, it actually did break, but then I was like, let me just watch it. So, and I was setting this up and I actually did, anybody who was in the room, I said, Meta is setting up a bullish 10 EMA setup. I called it out in the room. And as I was, watching this and I was trying to get it set up and this candle hit and I was like, let me just wait and watch this. And then it was just giving me this sideways action. And let me zoom in here a little bit more. Okay. So it was giving me this sideways action and not really showing me a lot of strength. Forget this candle. This candle hadn't come in yet. So it was showing me a lot of this. Maybe I can just do this. I'll hide that candle. Let's do that. Okay. So I'm watching this and I'm going, okay. This would have triggered me in, but I didn't have it set up yet. So I actually, let me correct that. My entry, once I missed that, I put my entry right here. So this was going to be my entry right off of this candle here. And so that was going to be just a limit buy. But then, and this is my point that I started to make initially about not letting other people influence your decision. I was looking to go long here, right? So now I just made 1.2 going short. I was looking to flip and I was going to go long. I see this candle set up and I was like, that's it. There's a great look. And that's what I look for. I look for a small setup candle right near the 10 EMA, right? The farther away the candle is from the 10 EMA, the less I like it. The bigger the candle is, the less I like it. A small candle like this one here, right near the 10 EMA, those are my favorite 10 EMA setups. So I go to set this up to go long, and what happens? And again, this is not to lay blame. I'm not blaming anybody because I should not have allowed anybody to influence my decision. But Johnny starts talking about the market and how the market looks weak and things could roll over. And he was like, oh, you're going to go long, kind of like, and I'm like listening to all this. I'm going, well, I don't know. Maybe I've got this wrong. Maybe I should, I just made 1.2 going short. Maybe that's the way to go. I'll just stick with a short instead of looking to go long. And, and at the time, the market was looking like it was going to roll over, in all fairness to Johnny. And again, I'm not blaming Johnny. I'm just saying what and everybody, this is a great example of how different traders can have different ideas and views of what the market is doing, right? So, and why you have to come up with your own concept and your own ideas on how you want to trade. So, but I was thinking of going long here, and then this candle would have triggered me in and didn't. I was like, let me just wait. Let me just see. And then it just started chopping around. And then it was like, this should have, if this was really strong, it should have just kept going. But then it was chopping around here. And I was looking at this and I go, well, this candle here, the low of this candle, 111.80, right? Low of this candle, 111.81. The low of this candle, 111.81. And I go, 3 candles in a row with basically the same low. And then I start thinking to myself, well, if that level, clearly that's a strong level. Clearly the bulls are protecting that level. If that level gets broken, it's going bearish. So now I'm flipping in my head my original thought of going bullish on this, right? Now, again, keep in mind, the overall trend at that point, prior to my trade here was bullish, right? We did break this pivot. So technically at this point that bullish trend is broken, but it did hold this pivot here. So anyway, so now I see that level right there, that 111.80 level. And I go, really strong level that the bulls are trying to protect. If that gets broken, it's going bearish. So what do? I flip my idea, my thesis, and I think, okay, this is going to go bearish if it breaks that level. Now, again, part of what happened there was I actually started listening to Johnny and his take on things. Now, again, this is not to lay blame at all. I'm not saying that, because I'm fully responsible for it, right? But a great example of how you should stick to your own ideas and your own trading plan. So then this candle comes in. And again, the low of this candle, 111.81. Again, clearly a strong level. That's when I go, if that level gets broken, it is going, if that can't continue to go up, it's going bearish. So I flipped my thesis and I set up a bearish trade. And after this candle came in, I was like, if that level gets broken, stop up here. And that came down. So now I'm looking at right here, 112. I was up in here, 112.58, maybe somewhere in here. That was my stop. My entry was right below here. Comes down. Didn't let me lower this now. That was my original long entry. So I went down here. I was like 111.78. That was it. 111.78 was my exact entry. And my stop up here was 112.58 right here. Okay. Right there. That was my stop. And so it's coming down here. And then we get this candle here, nice little indecision candle. And boom, breaks that level, right? Now, didn't break it convincingly, right? But it broke it. That triggered me in. I'm like, okay, fine. And also now we got to close back below the 10 EMA here, right? So, well, this one did too. But so we have now 3 candles that closed below. And technically, right, what is this candle over here, right? That candle is technically a 10 EMA setup. It's a bullish candle that closed below the 10 EMA. So here I am in my head checking off all these boxes, right? I'm going, okay, well, this level clearly is a strong level of support. It needs to get broken. It got broken. This is a 10 EMA setup candle here to go short because it is a bullish candle, small bullish candle, which I love, closing below the 10 EMA. There's another box to check off, right? Then this candle comes in, right? And at one point, this was a nice bearish candle. I was thinking, another home run trade. This is running right to my target here, which was down here, by the way. I figured if it went down, it was going to make a new low. It was going to break this low and potentially get back down here. And then look what happened. Wah, wah, wah. Just reversed on me. And then that candle came in. I was like, all right, now again, per my rules, right? This is where the trading rules come in and are very important. Let me back up. Okay. This candle came in and triggered me in. Now I'm in the trade. My rules say if the trade immediately goes against me, I can get aggressive with moving my stop. That's rule number 1 of the rules. Okay. Trade immediately went against me. It's pretty clear. I got triggered in at this point. At one point, this is a nice bearish candle. I thought for sure it was a home run trade. It got bought up and it closed above my entry. And that's actually a pretty nice looking bullish candle after this bearish one. So clearly the trade has gone against me and it went against me right away. So I can get aggressive with moving my stop. However, another rule I have is I cannot, if I'm going bearish, I cannot move my stop on a bullish candle. Can't do it. Why do I have that rule? I have that rule to stop me from overreacting emotionally to the trade going against me. Okay. So by having that rule in place that I cannot move if I'm going bearish, I cannot move my stop on a bullish candle, that stops me from doing something out of fear. Right. Next candle comes in. Now, clearly going against me. No question about it. But again, it's a bullish candle. My stop is still right here. I can't lower my stop on a bullish candle. I can't do anything at this point. I just have to let it ride. And those of you who are in the room might remember I was typing in the chat. I'm like, I really need Harry Potter to step in here now and help me out. If anybody remembers me saying that. Okay. Next candle, bearish candle. I'm like feeling a little better about it. Yeah. So Jack remembers that. So now I'm feeling better about the trade, but because I got a bearish candle here, now I can move my stop. Excuse me a second. Just need a little water. So because I got the bearish candle, I can move my stop. So I move my stop down to, and again, it's only pennies, but it's less than a full R, right? So I went from 112.58. I went above this candle here to, I think I went to 52, right? Is it a lot? No, but does it prevent me from losing a full R? Yes, it does. Okay. And that's the key. You always want to try to lose less than a full R. Next candle comes in. Okay. Now I'm looking at this and I'm thinking to myself, okay, we have this candle here. The low of this was 111.99. The low of this one, 111.99. Okay. Again, clearly another strong level here, but then we get this candle and it's an inside candle. And I'm like, we'll see what happens. This candle comes in. Okay. Now, bearish candle, right? And now I can move my stop again. Now I can't really do a whole lot, but this is the high of this candle is 112.48. So I think I lowered it another 2 pennies right there, right? 112.50. So now I've only lowered my stop 8 cents, but again, 8 stops, 8 cents on however many shares, on a decent amount of shares can be a lot. So next candle comes in and boom, I'm out of the trade. Okay. So losing trade. In hindsight, had I stuck with my original thesis and gone long, I would have had another 1.2 to 1.4 because look, I mean, this just kept going. Look at that. So had I stuck with my original long thesis, I could have had another great winning trade, right? So what's the takeaway here? The takeaway is trade your own plan. And, you know, just because somebody is, you know, whether it's somebody in the chat or whether it's the moderator, whoever it is, if you come up with a setup on your own and it's your concept, your idea, and it meets your trading plan, take that trade. Don't let somebody else influence your decision. That's the moral of this story. But anyway, thought I would share those ideas with you on that particular trade. So I won 1.2 and I lost less than 1. Okay, so still up on the day. Any questions on that before we move on to some of them? If you went long. So Terrence, let's do that. If you want, let's take a look at that. If I had that trade that I set up was right here, right? Actually, I'm sorry. After this candle formed, Terrence, you have to understand, I'm a fan. I like to do limit buys. I like to get the best entry I can. So that's why I don't often take breakouts or breakdowns. I will actually let price come back to me. So my original setup was right here, was 111. It was actually 111.88. I remember 111.88 was my original entry for this. This was to go long, right? And here's that candle. That was the bearish candle. That was the setup candle for the 10 EMA strategy. So I went there, and I also like my numbers to be pretty even. So I went 111.88 by 110.88. It was exactly $1, right? Sorry, I meant bull candle below. This candle here. Well, let me see if I can answer my question. I think I know what you're asking, Terrence. So if I had taken this trade long, if I'd done this trade the way I had originally anticipated, okay, I would have gotten triggered in. I would have gotten triggered in on this candle here, right? That would have triggered me in. I would have hung out here. And then this candle, once price got above here, once this candle formed, this candle here, I would move my stop from here to here. And then you're saying, sorry, I meant bull candle below. You were talking about on my bearish trade, my losing trade, the one I lost on. Yeah, so when I went short, okay, I went short right here. Stop was up here. And you're saying the bull candle below, what, this bull candle right here? Yeah. So, you know, again, with my trading plan, I can only move my stop, you know, where did I get triggered in? I think I got triggered in on this candle here to go long. I'm trying to remember. No, I went short. I'm sorry. I went short. This is the candle that triggered me in to go short. But yeah, this technically was a 10 EMA setup to go short. This one here. And again, that was another thing that I liked about this trade setup, was that I was looking back here at this level thinking if this level got broken, it would roll down again. And then this was just an added bonus that this was a 10 EMA setup. So I'm not sure if I answered your question. Hopefully I did. So, all right, let's move on to the topic. We spent more time on that than I thought we would, but hopefully that was helpful. But let's, at one point, would you start changing your rules? Well, Natasha, so first of all, you don't want to go changing your rules, you know, just randomly, right? You want to set your rules in place, and then you need to then use your trading experience to determine if the rules need to be tweaked, right? So for me, like, you know, stop movement, right? So before I had this rule where I can't move my stop, it was too easy to, so again, when I say can't move my stop, if I'm going bearish, I can't move my stop on a bullish candle. Before I put that rule in place, I would allow my emotions to get the best of me. And if price was going against me, I would get anxious and I would move my stop. Right? So yeah, of course, borrow the rules, right? Learn from others, right? If you can take those rules and apply them to yourself. Absolutely. So Natasha, I'm curious, how long when did you join RLT? I'm assuming last month. Okay, so Natasha, okay, look, let me help you out. Give me a quick second here. Bear with me. I gotta find something for Natasha. Give me 1 minute to help Natasha out here. Okay, where's my... All right, here we go. Okay, so here, Natasha, I'm putting a link I just put a link in the chat there for you. Okay. That is a workshop that I did on creating a trading plan. So I would highly, highly recommend that you, how long is this? Let me look here. The trading plan, trading plan workshop, hour and 50 minutes, right? It's a lot of information in there. I know a bunch of people that are in the chat right now, right above you. Oh, wait, I'm sorry. My bad. Hang on. I put it to, there we go. You should see it now. Sorry, I posted it to hosts and panelists before. I hadn't changed it yet. Change it over. Okay, so Natasha, so I know there's a lot of people in here in the room right now in the chat who, yeah, Kyle's one of them. So it's an hour and 50 minutes of how to create your trading plan. Highly, highly recommend that you take some time over the weekend. Check that out. All right, so let's go on to some of the other topics here. So the trading indicators. And so Natasha, I'm going to gear a lot of this towards you since you're relatively new to real life trading. I know there's some other people who are relatively new. You're going to benefit from this. So indicators. Okay. And I know a lot, bear with me. I know a lot of you have heard me preach this already, heard me talk about this. Okay. But always good to repeat it. So there are leading indicators and there are lagging indicators, right? Two types of indicators, leading, lagging, okay? Your leading indicators are the most critical, most important indicators you can use. Those are volume, right? That is an indicator, right? And people often think about these indicators, it's like, okay, well, RSI, MACD, you know, whatever. Those are the indicators they think about. But volume is an indicator. You add it to your chart. So volume is a leading indicator, right? Price action, meaning the candlesticks, right? What is the price action? This is the price action here, right? Price action is going down. Price action is going up. It's going down. It's going up. Price action, volume, leading indicators. They're the only two leading indicators, price action, volume. This right here, so you have volume down here, right? Which shows you how many shares have been exchanged, how many contracts. This right here is also volume. This is volume profile. And all of you who've been with real life trading or worked with me, you know that I use volume profile. This is just another way of looking at volume. So here you're looking at volume and you can see that there were, you know, however many millions of shares exchanged, traded here, right? That's what the volume shows you, how many. But this looks at volume on a price axis, tells you, you can just visually see here that the most volume on that day went off right around $113. So this is also a leading indicator because it's volume. It's just analyzing volume based on price, not shares traded, right? So I do enjoy, you know, I find it very beneficial to be looking here at the volume profile, because the farther that these extend out, that's the more volume that was traded. So the farther they extend out, the stronger those levels are in terms of what could be potential support and resistance. And then you get these clusters, right? These big blocks here, right? These clusters also are strong areas of support resistance. But then the shallower these are, the less strong they are, right? So as the day progresses and these nodes extend further out, you know that this level down here isn't as strong as what this level is here, and so forth. So volume profile, volume, and price action. Those are your leading indicators, right? Those are real time. You could trade off of those three alone and not have anything else. But let's talk more about what the other indicators are, okay? So moving averages. And again, I know a lot of you already know this stuff, but let's just talk about moving averages, okay? So moving averages. You have your simple moving average, Okay, so the simple moving average is so it's used to identify the direction of the current price trend. Okay, so let me zoom out here a little bit. All the moving averages, I should say, in general, are used to help to establish the direction of the current trend. Okay, the difference between the moving average, simple moving average, and the exponential moving average is, I'll compare those in a second, but the simple moving average takes into account the trend without the shorter term price spikes. Okay, and I'll get into that in a second. So on here, right, let me zoom out a little bit. Maybe I don't need to go that far out. Okay, so here, this is the 200 simple moving average, purple line. The 100 simple moving average. The 50 is the blue line, 50 simple moving average. On my charts, my 50, 100, 200 I use the simple moving average. For the 20 and the 10, I use the exponential moving average. Okay, and I'll talk about the exponential in a minute. But so if you think about what I just said, what are the moving averages do? What do? Is they help to identify the direction of the current price trend. Well, pretty obvious when you're looking here, right? If you look at this 200, the 100, and the 50, they're all sloping down. Very simple way to take a look at an overall chart and go, we're bearish, right? All of three of those higher time frame moving averages are showing they're down sloping. We're in a bearish trend. If you zoom out a little bit here, okay, take a look at this now in the 3-year, and you can clearly see that when the 200, the 100, and the 50 were sloping up, we were in a bullish trend, right? Very simple thing, but sometimes people just they don't zoom out enough to take a look at that and understand that those moving averages are just really giving you a quick glimpse of the overall trend, right? So pretty easy to see that when those moving averages are sloping up and price is above it, it's bullish. When those moving averages are going down and price is below it, we're bearish. Now, those are, again, I mentioned the simple moving averages, right? So now when you get into the exponential, the difference between the simple and exponential is the exponential is going to react more quickly, okay? Because it puts a greater emphasis on the recent data points as opposed to the overall. So when you look at the 200, so let's go back here real quick, the 200 simple moving average, and just to get into a little bit of the nuts and bolts, it's the average price over the last 200 days. Okay, that's where you get the number 200. That's the input. That's the number of days. Okay, same with the 100, same with the 50. It's the average price. It is taking the overall price action over that period and that's how it's forming that moving average. But again, well, I probably should have mentioned this before. What we're talking about now are lagging indicators, okay? Not leading. So I already covered the only leading indicators are price action and volume. The lagging indicators require historical data in order for them to plot. So they need price action and volume to have occurred in order for them to have produced something. So again, they're lagging, okay? Leading indicators give you a real-time picture of what's happening. Lagging indicators just help you, determine, in this case, an overall trend, right? But they are lagging because they have to have historical data in order for them to produce their results. So the exponential moving averages. So here, right, on this smaller time frame, this is the 10 EMA, 10 exponential moving average. And again, that's going to be more reactive than the simple moving average because it's putting more weight on the recent data than it is the overall data. Okay, so we here at Real Life Trading, we use obviously the 10 EMA, especially for this 10 EMA strategy. I also look at the 20 EMA, both on a daily chart and on an intraday chart. So if you go into my, yeah, Inga, this is being recorded. If you go into, let me go into a different chart here. So here's a 5-minute chart, right? I took a bunch of stuff off the other ones just to clean it up to keep it a little simpler for you. But here on this 5-minute chart, you can see here 10 EMA, red line, 20 EMA, the black line, right? This jagged red line is a 50, actually the 15-minute 10 EMA. I have an indicator that will plot for me a higher time frame indicator, so I don't have to go into. So here, this is the 15. If I zoom in here, this jagged red line is the same as this red line, right? I just know looking at it that it's the, you know, on the smaller time frame chart that that's the 15. But anyway, 50, here's the VWAP. So those are the exponential moving averages that I look at, right? But to keep it very simple on the 10 EMA strategy, all you need is that 10 EMA. You don't even need VWAP. I like to have it. I throw it on there. Okay. So those are the moving averages. Again, exponential and simple, right? And so the simple, again, typically are in the way I use them on the higher time frames, the 50, the 100, 200. Then on the smaller time frames, the 10 to 20, I use the exponential. Again, they are more reactive. Okay, and that's really the main difference between the two, is that the exponential is going to use more recent data as opposed to taking the data over a longer period of time. All right, so we covered the moving averages. We've already talked about VWAP. Let's go over some of the other, a couple of the other ones that, and again, these are, I want to be very, very clear here, especially for newer traders, right? I'm giving you this information not for you to think, okay, I have to use these things. No, you don't have to use any of these. In fact, I don't use really anything I'm going to show you other than what I've already shown you, okay? With the exception of maybe the RSI. I do use that from time to time, and I'm going to cover what RSI is. But the rest of these things that we're going to talk about, I'm only telling you about them just so you have the knowledge, so you have the information. But really, you know, the cleaner you keep your charts and the fewer indicators that you use, the easier trading is going to be for you, because you're not going to get stuck in this concept of paralysis through analysis, right? And that is a common thing that happens to new traders when you have too many indicators. But I know that people have questions about them, so I figure, okay, let me talk a little bit about some of the indicators that you might want to look at, okay? So I already mentioned RSI, so let's go there. If I go into studies here and I say edit studies, I type right here RSI. And I add that. That plots the RSI down here. Let me move this over a little bit. We don't need that much. Make this a little bit bigger just so you can see it more clearly. Okay. We go into a slightly smaller time frame. Okay. So you can see this pretty clearly. Now let me adjust a couple of these lines just to make them easier to see. Oversold, let's go with red. Overbought, let's also go with red. And okay. All right. So RSI, what is it? How do you use it? And so this is, RSI is one that I do like, and I do actually have on some of my charts. It stands for relative strength index. That's what RSI stands for, okay? And it's used to help you identify momentum. And then also it can give you just a heads up, if price could potentially start reversing, okay? And I say potentially because it doesn't mean it has to, okay? It just is, and again, that's what is really important, that you understand that these indicators that you were using, they're not a holy grail. I'm going to be very clear. These are not things that you want to just be using exclusively and making trading decisions off of. They are nothing more than tools to help you potentially identify an area where there might be a reversal, okay? Or just to give you a heads up that things might be changing, okay? So again, RSI, Relative Strength Index, helps you identify the momentum of the market and potential signs for a reversal, okay? And the range on the RSI goes from 0 to 100, right? Well, what does that mean? Don't worry about it. It's not important. What you need to know is that there are 2 key levels, actually 3. I'm going to give you the one that they don't include here, okay? So the key levels are 30 and 70, okay? And what they consider 30 and 70 to be is if the RSI gets below 30, things are oversold, okay? If price gets above 70, price is considered to be overbought. Well, what does that mean? Well, all that means is that if you see that price, if the RSI gets below this 30 level, and it's indicating that the price is that the stock itself is oversold, well, you could expect it to correct and come back into this area, right? So if you look here at price action right here, we got this gap down, right? And then it got into the oversold area. And again, price can stay oversold and overbought for an extended period of time. It doesn't mean they're just going to hit that and turn around and go the opposite direction. But you do want to be aware if you're watching RSI, when you get to be oversold, if you're already in a trade, you might want to be tightening up your stop. You might want to just be aware that it is oversold, and you might want to be looking at, potentially taking profit or taking a little bit off, tightening up your stop, whatever that might be. But you can see that when it gapped down here, it technically got into that oversold area, and then it came back up when it made the move up. Now it's back into its normal trading range. Okay. So the normal trading range is the important thing here. And the one number that they don't give you when you pull up this, maybe I'll go to a different, I'm using Meta, but let me try, let me just, sorry, I'm looking for one that's going to give me a, I want to see if I could get one that was giving me several different overbought and oversold looks. And I was trying to do it with not one of the ones that's going to give me a ton of, I don't want to use this because I don't want you to get confused with all those lines that I have on there. Yeah, AMD, Matt, I'm also going to have a bunch of lines on there because I trade that frequently. Let me think. Okay, Disney. Well, I have those lines there too. Let's see. Okay, INTC. Let's do that. I can just get rid of these lines. I don't need them. Okay, INTC. So here we have price coming down, right? And you can see here, price got into the oversold area, right? And then what happened? It hit this lower part of the oversold, and then it started heading back up, and price did go up. It got up there, but then it didn't get back into. Let me also mention real quick. Here's the one level. Rivian. Everyone loves Rivian. Here's the one level that they don't give you that you should throw a line on. And all you got to do is go here, price level, right? Give yourself a line right here and change that to 50, just an even 50. Okay. And that's the one thing that I would say, if you're going to use RSI, throw in that extra line there. You want to be looking, yes, it's important to know that you're overbought, oversold, you know, below 30, above 70, great. But 50, okay? 50 is that level that you can just quickly look at and go, okay, well, if price is above the 50 level, it's bullish. If it's below, it's bearish. That's simple, right? Now, does that mean it's going to, you know, be right 100% of the time? No, but as a general rule, if you're using RSI, and you can just look at this example, right? Here, we're bearish, right? We're going bearish. All of a sudden now we're making higher highs and higher lows. We're going bullish. Well, price got back, not right now, we're back above this 50 line. So that 50 line is just a down and dirty, easy way to look at RSI and go, well, are we bullish or are we bearish? And right now we're bullish, right? Price is above that 50 line. But if you look here, let's just go over this, that, okay, we got oversold and it came back up and it tried to get back into the, you know, it's where it likes to be, right? But then it sold off a gap down, it sold off again, got oversold, right? So we're back into the oversold area. Tried to push up again, but then got rejected, right? Now, what you can look at is if you look at this, you can draw these, also draw lines this way, okay? Okay, so as price was going down and it was oversold, the RSI is moving lower, price is also moving lower, right? But look what happened here, right? So you're looking for a divergence, right? So here, they're in line. Price is right here. Price is moving lower. RSI is also going lower. But then look what happens here. Price is moving lower. But what is the RSI doing? At the same time, it's going up. There's your divergence. That's what you want to look for when you're using RSI, is especially when you're talking about looking at the overbought, oversold areas, right? When they get overbought, oversold, look for the divergence. And the divergence means price is going down. You can clearly see that here, but what's happened with RSI? It's going back up. So that is a bullish divergence, and you can use that to your benefit. If you're seeing RSI moving up while price is moving down, you can anticipate that there's likely to be a bullish move out of that, okay? And look what happened. Now we are making higher highs and higher lows. We made a bullish move out of here, and look what's happening with RSI. It's going up. But that's a beautiful divergence right there, right? This was in line. This was an area where price and RSI were in alignment. But then here, price went lower, RSI started going up. There's your divergence. Look for that. And that can give you an indication for that price is about to turn around. Okay. Now, again, with the 50, using that 50, right? Again, just use that as a gauge as to whether or not we are bullish or bearish. Right now, we're above, and this is on INTC. Right now, we are above the 50. So you could expect to be looking to go bullish until it gets below that 50. Okay. Now, if price gets up here and it breaks above here and it is now overbought, again, things can stay overbought, oversold for extended periods of time. It's just meant to just get your attention, go, keep an eye on this. Okay. Again, it doesn't mean like once things get overbought, you exit your position. No, it can just keep running, right? Look how this stayed oversold this remained oversold from here to here. Well, basically back here, right? So this whole area right here, how many days was this? This was 1, 2, 3, 4, 6, 7, 8, 9, 10, 11, 12. Probably the better part of over half a month of being oversold, and price kept going down, right? So just don't think that as soon as something gets overbought, oversold, you need to exit. You don't have to. You just want to be aware that, you know, it could start to have a course correction. All right. RSI, any questions on that? I'll take that as a no. Okay. Let's see. I have 7 minutes left. I'm going to show you all. I had a whole list here that we didn't get to, but I did talk about the ones that I think are the most important ones. But I'm going to show you all something that's kind of cool that you may or may not have heard of. I used to trade off this quite a lot when I was newer to trading. Okay, is anybody here familiar with the, you might have heard people talking about it, but are you familiar with the Ichimoku cloud? Ichimoku cloud, anybody? Okay, Vaughn used to use it. Okay. So nobody else. Cool. All right. Well, then I'm going to hopefully show all of you something that you've never experienced before. So Ichimoku cloud. Okay. Let me see if I can give you, I don't even know if I have let me see if I have a decent explanation as to, okay. Okay, so it can be used for support resistance. Before I throw it up on the chart here, it can be used as support resistance. And then also it can show you like kind of a neutral area where you wouldn't take a trade at all. And so it's supposed to help you identify the market trends using support and resistance levels. That's kind of the gist of it. Let me first, I'll blow this up a little bit and I'll add it here. Okay. So if you go into studies, again, this is, you know, Thinkorswim, but if you go edit studies in here, if you type in Ichimoku cloud, Ichimoku right there, add that. Okay. That didn't add it. Hang on. Take two. Okay. There we go. Ichimoku cloud. Now, let me just highlight this. Let's edit. Let's get rid of a couple things. This we don't need. This we don't need. Span A, span B we want, and this we don't need. Boom. Okay. That is, let me zoom out a little bit. Ichimoku cloud. That's it. Okay. Like, all right, great. What about it? Well, it's actually pretty cool, and you can trade off of it on a daily chart, weekly chart, monthly, but you can also use it intraday. It's just a and that's why I used to trade with it a lot, just because it's a very easy way to look at, well, should I be bullish or bearish? And it's just support resistance. So when you zoom in here, this area here, the shaded area is the cloud. Right? So when you're below the cloud, you're bearish. When you're above the cloud, you're bullish. And when you're in the cloud, it's neutral. There's no trade. You don't take a trade inside the cloud. And so if I zoom out here a little bit, okay, you can see, well, especially here, right? And then the cloud itself can act as support resistance. So in this case right here, a great example where price, you know, we're below the cloud, right? So you're bearish and it comes up and it touches the cloud here, and there's your resistance, and then it comes back down. Now, if you notice, right now we're inside the cloud. So this is interesting because if you take a look at what we just looked at with RSI, it was showing us that we should be bullish now, right? So again, that's why you have to look at all these things and go, well, you know, take from it what you want. Don't allow it to dictate all your decisions. But right now, if you trade using the Ichimoku cloud on the daily chart, technically we're inside the cloud. That means we are neutral, there's no trade. But let's go and look at the cloud on a intraday time frame to make this a 5-minute chart. Let me just edit it real quick. Take that off. There's, you know, these are all just like lines that will go on that you don't need. All you really need are span A and span B, and that establishes the cloud. So if you look at, and let me get rid of the volume profile just to, so it doesn't confuse you. Get rid of the volume profile. Okay. So on a, so this is a 5-minute chart, right? So if, you know, and so think about this, like if you were looking to trade today and you go, well, am I going to go bullish or bearish, right? Well, prices, if you're using the cloud, price is above the cloud. So you want to be bullish, right? If you look back here, price is below the cloud. You want to be bearish. And sometimes intraday, you will get price action going in and out of the cloud. Let me go to a different, let me see if we can get something that is moving in and out through the cloud. Yeah, so, you know, here at some point, right, price would have been inside the cloud, and that's a neutral. Natasha, honestly, I don't know. So the answer, again, back to my statement that it's like, you know, don't really want to know why as much as, you know, just the basic, which is the cloud, above the cloud, you're bullish, below the cloud, you're bearish. It's just a quick and easy way to help you identify the trend. So Mark is asking, is it related to MAs or VWAP? So what goes into it? Let's see. And again, Mark, you know, I don't know. It's called the Ichimoku, Terrence, Ichimoku. So if I look here, right here, you can see Ichimoku, right? So it is based off, see the 9 and the 26, those are moving averages, right? So if we edit, if I click here and edit, so these periods, the Tenkan and the Kijun, these are moving averages. It's the 9 and the 26. Okay.
You guys are talking Ichimoku cloud, man. It got wild up in this one, huh? Jeez. Most complex indicator known to man.
I know. And that's why I start off by saying, like, look, when I ask what time it is, just tell me the time. I don't want to know how the clock is made. Right. So I was like, okay, so then with the cloud, all you need to know is above the cloud, you're bullish, below the cloud, you're bearish. Right.
Is that it? Aren't there like 4,000 other different things?
There are, but when you want to keep it really simple, it's price above, price below, and that's, you know, all you need to know.
All right, there it is.
Let's see. I was looking here, I was trying to find an example. There you go. So you could, if you went and traded on a 1-minute chart, right? You can kind of see, you know, you're below the cloud, you're bearish, right? You get into the cloud, it's neutral, you don't do anything, right? And then again, below the cloud, bearish, above the cloud, bullish. Anyway, it's just, it's intriguing. I mean, yes, you could do a deep dive into this, and to Yates's point, find a gazillion, you know, things inside of this. George, I used to use it, believe it or not. I did used to use the cloud long time ago, but it's still kind of a cool indicator that I will look at from time to time, but I don't actively trade with it. What happens if you had moon phases? Do you get atmosphere? Yes, you get a it's gonna rain. So, hey, well, that was a quick hour and a half. Did you hopefully you enjoyed lunch?
Yeah, man. I deboned a few Costco chickens and they're ready to go for meal prep. So yeah, man.
Nice. Cool. Okay. Let me stop my share. I'm going to make you host again. Make host. All right, brother. It's all you.
All right, man. Peace
All right.
out.
Thanks everyone.
for
Everybody have a
hanging
great
out.
weekend. Thanks for being with me this last hour and a half. It was fun.
Oh, do you wanna stop your recording on your end?
Yeah, I'm gonna log off and it will stop it.
Okay, sweet.
Yeah, so we're all good. You're the host, so nothing I do will affect you.
Sweet. All
All right,
right.
have a great weekend. Enjoy.
Peace out, man. All right. What up, George? Let's do it. Recording to the cloud. Make sure they got everything up and going and ready.